and assume that investors are going to expect a 10% rate of return for investors, how would we go about calculating the value for this, okay? It's a slight modification of okay? And so what you're going to be doing, if we sort of, once again, go back to here for a second, and it's a little bit counterintuitive at first. All right, so we've got our income, that's our 20,000. And normally you just say, okay, well, we're going to take our rate of return, so that means our value on this is 200,000. But we've got to take into account this growth rate business. Okay? Now, were any of you in here, this is not a big deal, I'm just kind of curious, were any of you in here finance majors at the undergraduate level? Nobody? Not even you?
Not even you.
Economics.
Okay. All right, well, one of the fundamental sort of finance models, and you can actually Google it so you'll not be lying to you, was called the Gordon growth model, okay? And this Gordon growth model was basically a variation of this, of where you would adjust the rate of return to reflect growth in terms of income growth over the life of the investment. And mathematically, what you do is you take the rate of return and you subtract out the growth rate, okay? So in this case, we would be subtracting out this 0.02. Now, as I said, it seems kind of counterintuitive, okay? So, but let's do the math here for a second. So that would mean 0.08 would be our revised sort of percentage that we would use there. So 20,000 divided by 0.08 means our revised value estimate would be 250,000. Now, this is the part that will help to maybe make it make sense. So, conceptually, if you're thinking about this, we're saying that this income number is going to grow by 2% a year forever and ever and ever, okay? So naturally, if the income is growing, you would expect the value to be increasing, yes? Okay, but the part that usually stumps people, just conceptually, is they just can't wrap their head around why you would subtract the growth rate instead of add it. Because, you know, your first intuition is to say, oh, I'm going to add 2% to my, you know, rate of return, and therefore, you know, that's going to, you can't look at it like that. The way that you've really got to be looking at it is from the standpoint that, in essence, you are growing your income, and therefore, what you could do mathematically, we don't really want to get into this, so I'm not trying to make it more complicated, but we could be adjusting our income number substantially to accommodate this as well, because what we could do is, in essence, say, well, you know, what is that income number going to be at some point in the future? Well, the problem with that is it's not a constant amount. It's going up 2% a year. So even if you did the math and you said, well, this is going up 2% next year, 2% the following year, 2% the following year, and so forth, so on, and so forth. Now, if we built a spreadsheet and we applied that to every single, you know, year, we could accommodate that. But the only way mathematically that we can accommodate that is to put it here in the denominator to subtract it out from our actual growth rate, or actual, I'm sorry, our actual rate of return. Okay? All right? Make sense? Okay, moving forward. Okay, last topic before the quiz. Okay, but it's a biggie. That's why I saved it for last. Okay. In your book, there is something referred to as mortgage equity capitalization. Okay? If you don't believe me, look in your index. Okay? It's Specifically,
I believe you.
We all believe you?
what's it look? Mortgage, equity, and, yep, there it is, page 314.
And guys.
Land values. Okay.
What's up, guys?
Mortgage equity capitalization, bottom of page 314, and then pretty much all of 315 and 316. Okay. Now, what is it? Basically, what it boils down to is you are going to be looking at what the value of a mortgage is going to be on a property, and then the value of your equity on the property, adding those two numbers together to come up with, in essence, the value of the actual asset itself. Okay, well that seems very simple. You have a mortgage value, and you have an equity value, and then total gives you the mortgage equity capitalization, okay? But with that, you've got to sort of be given a handful of variables to sort of get there, okay? So let me walk you through an example. Okay, so once again, I'm just going to, the basic formula is going to be the present value is going to be the mortgage plus the equity. All right? So let's say that we have annual net operating income of $50,000, and we have a debt coverage or debt service coverage ratio of 1.20. All right? Knowing what we talked about earlier tonight, we said that the debt service coverage ratio is equal to what? Net operating income divided by annual debt service. Yes?
Yes.
Okay? And we've already done a good portion of this, but this is kind of to refresh you. Okay? So if we know that our debt service coverage ratio is 1.20 and we know that our NOI is $50,000, if we do the math, then we should get $41,666.67 as our annual debt service. Okay? So far so good. Okay? Now then, from that, assume that we get a mortgage loan for 20 years and an 11% interest rate. All right, what's going to be our monthly payment? Sort of a trick question. What's going to be our monthly payment? What are we going to do?
$34.72.
And you're going to get that by doing what? Simply taking the 41,666.67 divided by 12. All right, so your monthly payment is going to be $3,472.22, correct?
Yes.
Okay, so now what we need to solve for is the actual loan amount. Okay, so in so doing,
Is that like the present value?
Yep.
plan?
12 payments per year, 20 years, 11% interest rate, 34.72.22 as our payment, and then solve for present value. Okay, so should get 336, 394.02. Yes? Okay, so that is M. That is our mortgage. 336, 394.02. Okay, so that means we're still missing the equity piece. Okay? All right. This is where it begins to get a little more complicated. All right? All right. For the equity piece, and this will just sort of see if you're thinking about things. When we look at the income statement, you know, we did the whole PGI minus vacancy, inflation loss, plus other income, gives us effective gross income, subtract out total operating expenses, gives us NOI, subtract out annual debt service. What are we left with?
Before tax cash flow.
Before tax cash flow. Yes? Okay. Now, from an equity perspective, that is money that is going to give us or provide us with a return on our equity. Yes? Does that make sense conceptually? Yes or no? Okay? So, in essence, if we know what our annual before tax cash flow numbers are for the next several years, and we know what the resale price is minus our mortgage amount, and we know what our required rate of return is, we can figure out what the value of our equity should be. Does that make sense? Okay, so follow with me. So what we're basically saying, one payment per year, 0 as our initial cash flow, and then our before tax cash flows for each year are as follows. 83.33 for the first year, that's before tax cash flow for year 1. For year 2, 98.33 for year 3, 11.378, 12.969.
How are you getting cash flow?
I'm giving them to you.
Oh, okay, okay.
You're all thrown a loop. What? How you jump from there?
Okay, and so the final year is going to be 14,608 plus that. Plus the resale value of 526, and once again I'm giving to you this as well, minus the mortgage balance at the end of 5 years of 305,495, meaning 221,450.
Wait, what was the 14.6?
Okay, the 14,608 is your before tax cash flow for year 5. And then this is your reversion amount in the sense of your selling price is going to be 526,945. Your balance on your loan at the end of 5 years is going to be 305,495. The difference between the two of them, 221,450. And then you are simply going to put that in as your final cash flow. And then you're going to say a 12% rate of return is the expectation, and then solve for net present value. And what you should get is 165,566. Okay? So that number $165,566 becomes your equity piece combined together. The overall value for the property would be $501,960.02. Okay? Now, my suggestion would be to actually spend a little bit of time. Don't stress out about this for this quiz, but I would spend a little bit of time playing around with this. This is a very valuable kind of valuation technique because it allows you to sort of set some parameters with respect to your cost of debt, your required return on equity, to come up with what the value would be for a particular asset to you as an individual investor, okay? As opposed to just simply applying a fairly basic sort of cap rate, okay?
How come you have that 305,495?
This is the outstanding mortgage balance, so what you would need to do to get that number, if you actually had to calculate it and I wasn't giving it to you, you would just simply do one input 60 or 60 months, shift, amortize, equal, 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 and then that would give you, or should give you, the 305,495.
But you're going to give us that.
I'm giving you that. Okay? Now, the point that I want to make with this is definitely one of the incentives for taking the quiz versus taking the test. I'm going to give you all this on the quiz. On the test, you're going to have to do it. So it's definitely an incentive to do well on the quiz. Okay? Okay. Any final questions?
So if you were to ask the overall
The overall value,
it would be the two numbers, 33.
Basically, we'll,
it would be the 501,960.02, adding those two together.
Okay.
Okay?
how did you get the 501,960?
I added 336,394 plus 165,566.
So the mortgage amount versus plus.
Mortgage plus the equity. Okay? Okay, here we go. It is quiz time. Okay, everybody should have their answer sheets in front of them.
It was 165, right?
Yep.
He gave us